All right, futures trying to push higher right now despite some disappointment on the earnings front. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Bonnie Quinn. Matt Miller and Sonali Basak are off. Bloomberg Open Interest starts right now.
Coming up, disappointing outlooks from industry heavyweights. Ford sees a sharp drop in profit as Qualcomm faces slowing smartphone growth. Meanwhile, Honeywell announcing it's splitting into 3 independent companies, following pressure, of course, from activist investor Elliott. And its yields, not the Fed. Treasury Secretary Scott Bessent says that the administration's focus is on that 10-year Treasury rate. Bessent joins Bloomberg today at 1 p.m. Eastern. All of that and more coming up, but let's take a look at where these markets are trading. We actually saw a bit of a rally into the close yesterday, and you can see that we're trying to maintain that momentum right now, even though, as we mentioned, some disappointment when it comes to Ford, when it comes to Qualcomm. But nevertheless, you can see the S&P 500 currently higher by about 0.3% if you round up. The NASDAQ 100 a little bit less than that, but still green. And then you take a look at the 10-year Treasury yield. It's pretty much unchanged right now, but at a relatively low level relative to where we've been over the past few weeks at least. The 10-year Treasury currently trading at 4.42%. And Bonnie, apparently this is what we should be watching because this is what Trump and Bessent are watching.
And there was a 10 basis point move yesterday, so you know the market is watching everything Bessent has to say as well. He's on Bloomberg TV, by the way, at 1 p.m. Eastern. We'll speak more about that. But let's get into some of the details of some of these stocks that are moving pre-market. Qualcomm down 5.3%. It sees the smartphone market relatively flat this year, as we've been saying, weighing on its forecast and raising concerns around sales growth. Ford out with a warning that profit may fall by $2 billion or more this year, citing lower car prices, also costly newer models, and also the threat of tariffs, of course. And then Tapestry shares, they are popping after it raised its guidance for the year, thanks to stronger than expected sales for Coach. So one great news story this morning, at least, Katie.
Yeah, there is some green on the screen, at least when it comes to Tapestry. I want to go back to the bond market, which we don't usually do at 9 a.m., but those comments from Scott Bessent yesterday on Fox Business, he'll be joining Bloomberg TV later today, really interesting when it comes to the focus on the 10-year Treasury yield. It's not the pressure on the Fed that they're piling on right now. It's this 10-year Treasury yield, which is a hard beast to tame, Vonnie. You take a look at just what we've seen since the Fed actually cut rates by 50 basis points in September. We've gone straight up, give or take. And you have to wonder, I mean, beyond watching, is there anything that they can possibly do? It doesn't feel like it.
I mean, if you look into the details of what he's saying a little bit, he talks about expanding energy supply, bringing the cost of heating oil and diesel down, thereby impacting somehow the deficit. But it's a very, very difficult thing to do. John Authors of Bloomberg Opinion pointing out today that Alan Greenspan tried to do this in the years before the great financial crisis and didn't get anywhere with it. Now, he wanted yields to go up, not down. But again, didn't go anywhere. And you can buy industrial quantities of bonds, right, to try and impact the yield curve, but really that's quantitative easing. Do we really want to go back there?
Yeah, and that of course requires a discussion with Jerome Powell as well. So interesting to sort of thread the needle there. Let's try to do that with Ritholtz Wealth Chief Market Strategist Callie Cox. And Callie, I'm curious to hear your opinion, your thoughts on what we heard from Treasury Secretary Scott Bessent last night, because it feels like you could build a case that this administration cares much more about the bond market than they do about the stock market, which is what we saw in the first administration.
We know that Trump cares a lot about the stock market too, but I think the bond market is the point to watch right now for investors, even for the everyday investors who think that interest rates may not matter to them because it affects how we all think about money. But the 10-year yield is a complex beast. And look, Scott Bessent came out with the QRA. He basically said status quo for supply and issuance for the next few months, which is great. Status quo is something that markets crave these days. It's certainty in a world of uncertainty. But at the same time, the 10-year yield has been whipped around by all these unusual forces. Worries about the deficit, worries about inflation and where that's going, worries about Fed and fiscal policy. So it might be harder to tame than Bessent is leading on. And, bond investors might have more agency than they think they do here.
Well, and just to tease that out a little further, Callie, the more you temper and tamper with the 10-year yield, the more that starts to impact stocks, right? Via corporate debt and so forth.
Yeah, exactly. I mean, I think people forget too that, again, going back to interest rates affect how we all think about money. This is a big deal for corporate America, and it's a big deal for the housing market as well. Mortgage rates are based off of the 10-year and longer term rates. And, a lot of corporates do borrow further out down the curve. I'm a little worried about that because, we have the Fed keeping the short end of the curve up. And now the long end of the curve is, increasing and showing that it could have a higher base. That combined with all the policy uncertainty we're struggling with these days could mean that it's a rougher environment than most expect for corporate America this year.
Yeah, absolutely. Those fears, you've seen them on and off in the stock market. So let's talk a little bit more about that relationship. When it comes to the long end of the Treasury curve, every now and again, every time we get meaningfully above 4.5%, it feels like those jitters come out. How do you see that dynamic evolving?
Yeah, there's something about 4.5%, and I'm not a technical analyst. Maybe it's just a round number thing. But whenever we cross that threshold, it seems like the stock market is a little more attached to the 10-year yield and where it's going. I think the base for the 10-year is much higher than it was 6 months ago. I think it's because the economy is stronger, and the risks for inflation are higher inflation are still a little bit higher as well. But I'm not so sure that 4.5 is where the 10-year yield evens out here. It's so hard to tell, Katie, because a lot of this pricing has to do with that uncertainty around policy, uncertainty around the deficit, really things that sit, a ball that sits in the administration's court. So, I don't envy somebody solely focused on the bond market right now, but I think at the moment it might be more important to focus on the 10-year yield as this generator of yield than this economic hedge that many investors use it for.
Just a moment, Callie, if you would, on this market. Jim Tanos yesterday said something very pithy to Bloomberg. He said, bull markets place a premium on promises. Is this a market trading on promises?
I think in some parts it is. And I would never go as far as Chanos here. I would never invoke the B word. I don't think we're in a bubble at the moment. But, tech is trading on high expectations. It's trading on this AI story that we've learned in recent weeks, could be evolving a lot quicker than some think. So, we still like value here. We still like looking at stocks that trade closer to their earnings. We think cheaper cyclical sectors could be interesting in this moment. But on the whole, I think it makes sense to get your portfolio back in balance, especially if you're one of those investors who has benefited from a pretty stunning tech run over the past few years.
Callie, we have more than 50% of the S&P now reported, and really we've done well. Howard Silverblatt pointing out that we have almost 80% of companies beating estimates. What do you foresee for the other half of the S&P?
Well, we're in the middle of earnings season from a count perspective, but much of the S&P's market cap has reported. So in some ways, we're in the later innings of the earnings season, Vani. I like the beat rate. Of course, you want to see 80% of companies beating their earnings expectations. That's much higher than the 5-year average of around 70%. But this has been the story of corporate America the past few quarters. Wall Street almost underestimates them every single quarter, and they come out with stronger earnings than everybody expects. That doesn't mean it's smooth sailing, though. I mean, of course, we saw some mixed results out of big tech, and that was obviously a stumbling block for the market. I'm listening to, again, CapEx concerns, mentions of tariffs, and, setting the bar as we move into later in the year because Wall Street has raised the bar for the coming quarters.
All right, Callie, always wonderful to speak with you. Thank you so much. That is Callie Hawkes of Ritholtz Wealth Management. Honeywell will split into 3 publicly traded companies, separating its aerospace division from its automation business and proceeding with the spin-off of its advanced materials arm. Its earnings forecast missed estimates this morning, sending the stock lower. Let's discuss now this big change for Honeywell with Bloomberg's Brooke Sutherland, who covers industrials. So, Brooke, is this simple enough now? It's broken into 3. Bloomberg Intelligence suggesting that it could be broken up even further were management to go further.
I think that's the big question, because if you look at what's going to remain in the automation business, yes, there is a very sizable, what we think of traditionally as automation, but there's also building controls, there's warehouse robotics, there's fuel processing technologies. And what we've seen with other conglomerates that have done these big breakups is it usually takes a couple of them to get to the final simplified structure that these companies end up settling on. We've seen that with Danaher, we've seen that with GE, we saw that with Trane Technologies, with Fortive, which was itself a Danaher spinoff. And so I think that's just going to be the question of, do you have a coherent enough narrative for this business that's going to remain that it's attractive to investors. But on the other hand, the aerospace part of Honeywell will be a lot more focused. We've seen, really great performance in a lot of pure play aerospace stocks, GE being one of those that did its own big breakup. And so I think this is something that investors are going to be excited about, to be able to own that Honeywell aerospace business by itself.
Well, when you think about spinoffs in general, they've been so popular in the stock market. You think about General Electric, for example, that was well received. You take a look at Bloomberg's index of spinoffs over the past 5 years or so. We're right near record highs, even though it's been a pretty rocky market, Brooke. I mean, talk a little bit more about how investors are receiving this news.
Sure. I mean, I think what we've seen over time is that you have to have a really good reason for having a diversified business model. And I think, companies have to sort of constantly be proving why their various pieces fit together. And in the case of Honeywell, I think they have very good businesses, but what happened is they were often trying to tell too many stories at the same time. And you had sort of, a downshift in one business at a time when another was performing well. And that's what you see with a lot of these conglomerates, is it's just too much going on at one time. What I will say, though, is that, for all sort of the last rites pronounced over conglomerates, there are still quite a lot of very diversified business models. If you look at Amazon, they have an e-commerce platform. They sell groceries. They have cloud services. You look at Microsoft, they have LinkedIn. They have also cloud services. They have Xbox video games. I mean, and, these examples really do persist. And so I don't think the model is entirely dead. It's more a question of how can you make it work in a way that, doesn't turn off investors ultimately?
It's a great point. We're not entirely past the age of conglomerates. Brooke, always great to speak with you. That is Bloomberg's Brooke Sutherland. Meanwhile, some other movers we're keeping an eye on. And let's talk about Peloton. Cost cuts have bolstered profit more than anticipated, revenue continuing to shrink. But even still, the stock up 18% right now. Definitely needed some good news. Take a look at Roblox, though. Roblox daily active users missed expectations. It also lowered its 2025 booking forecast, shares down almost 18%. And to Under Armour, it raised its annual profit guidance in a promising move for its turnaround strategy, shares up about 5%. Meanwhile, coming up, Eli Lilly sees growth from its Mounjaro and Zepbound diabetes drugs. Details on the latest earnings and the outlook next. This is Bloomberg.
Now to high interest, a look at what's making headlines around the world. Aides to President Trump are trying to tone down his idea of taking over Gaza after he suggested the U.S. would, quote, own the war-ravaged territory. Trump's proposal was made at a news conference alongside Israeli Prime Minister Benjamin Netanyahu. The idea was welcomed in Israel, though widely condemned elsewhere in the Middle East and among Washington's top European allies. U.S. Treasury Secretary Scott Bessent says the Trump administration's focus on bringing down borrowing costs is on 10-year Treasury yields rather than on the Fed's benchmark short-term interest rate. Bessent also repeated his view that expanding energy supply will help lower inflation. Bloomberg's Saleha Mohsen will have an interview with Secretary Bessent today at 1 p.m. Eastern. Around 40,000 federal employees have taken up the U.S. government's buyout offer. That's about 2% of the federal workforce. The White House earlier estimated that between 5 and 10% of the federal workforce could take the offer.
All right, switching gears here, let's go back to earnings season because Eli Lilly out with earnings today that were mostly in line with estimates. The drug maker is working to fix inventory problems with its new blockbuster obesity drug that weighed on sales in recent quarters. Bloomberg's Madison Muller covers Lilly and joins us now. Madison, great to see you. So for better or worse, it feels like when it comes to the GLP-1 market, there's this duopoly. You have Eli Lilly and you have Novo Nordisk, both of which have reported in the last couple days. How did they two shape up against each other?
Yeah, so I think that there was some concern given the last two consecutive misses from Lilly's obesity drugs that maybe something was going on with demand. Like, is this market that seems insatiable, is it actually slowing down? And so there was definitely some concern, I think, going into both companies reporting this quarter. And Novo is looking pretty good. I think that relieved some of those concerns. Lilly is also saying that, a lot of the last two misses have had to do with inventory problems. And they're still forecasting I think it's like up to 35% revenue growth for 2025, which is huge. So that's like at least $12 billion in added revenue this year. So clearly there isn't a demand problem. And what Lilly's explanation, at least, is of what's happening is that there's some inventory problems in the channel of wholesalers and pharmacies. Basically, at the end of the year, they typically see a ramp up in wholesalers having more stock on hand, and they just didn't see that for whatever reason this quarter or the last 2 quarters. And so they're not going to try to forecast seasonality going forward and just really look more at the demand dynamics.
Madison, what comments are we hearing from management about the potential confirmation, which looks very likely now, of RFK Jr. as HHS Secretary?
Yeah, so I was just talking to Lilly's CFO about that earlier this morning, and they said that their agenda isn't really changing. I mean, for one, a huge thing for drug makers has been the Inflation Reduction Act. And so that's something that when we were at JP Morgan last month, Eli Lilly's CEO said that Lilly and other drug makers are looking to try to revise some of the provisions of the IRA this year. They're asking the Trump administration to pause those negotiations going forward so that they can revise some of these policies, one of them being what they call the pill penalty, which allows pills to be negotiated for lower drug prices sooner than biologic drugs. So that's something they're really focused on. They're going to continue focusing on that with the Trump administration. And when it comes to RFK, again, they say, they do have more common ground, I guess, than differences, because RFK does have this focus on chronic disease, and obesity is a chronic disease. So they're trying to make it work there. I think it was a couple months ago, Eli Lilly's CEO was at Mar-a-Lago with Trump, and even before inauguration. So these conversations, they've gotten the ball rolling, and I think that they're getting their agenda out there to the Trump administration.
Yeah, it's going to be really interesting to see how those relationships develop and evolve here. I am curious, though, talk about the pipeline when it comes to Eli Lilly, when it comes to Novo Nordisk. It feels like both of them are trying to basically develop and get out their next generation obesity drugs. What does that timeline and story look like? Yeah, so both of them are taking slightly different approaches. I think in the near term, at least, Lilly's biggest thing, and from what I've heard from a lot of the conversations at JP Morgan, people were saying the biggest pharma readout this year is going to be Lilly's oral weight loss drug. So that's expected around mid-year, and Lilly is really far ahead of everyone else with developing a pill that is, potentially easier for people to take who don't want to have an injection. And so that's something people are really looking for this year. That's going to be pretty important. Novo is focusing more on next generation shots. They do have an obesity pill as well, but because they've had such a struggle with supply problems, they really haven't had enough supply to actually make these pills, because it uses the same ingredient as Wegovy and Ozempic. So they've been focused on this next generation drug, CagriSema, which was a little bit disappointing to investors at the end of last year, but we'll see what happens with that.
Madison, thank you so much. That is Bloomberg's Madison Muller joining us there. We're also, by the way, speaking about Bristol Myers Squibb ahead of the opening bell, down about 3.5% now. 2025 sales and profit forecasts were below Wall Street expectations. Declining sales of older drugs will likely slow the company's return to growth. It plans to eliminate $2 billion of spending by the end of 2027, and that's on top of the $1.5 billion already planned through the end of this year. This is Bloomberg.
All right, welcome back to Open Interest. You're taking a look at futures right now. With minutes to go until the opening bells ring, you can see the S&P 500 up about 0.3%. The NASDAQ 100, it's in the green, but just so, barely 0.1% higher. The small caps making a run for it. The Russell 2000 currently up about 0.4%. Of course, maybe that focus that Scott Bessent and Donald Trump have on the long end, maybe giving a little bit of relief to the small caps. Of course, they would certainly like to see lower rates, and it seems like the administration would like to see that as well. I was just taking a look at the year-to-date figures, Vonnie, and it's interesting because you take a look at the NASDAQ 100, the S&P 500, both up about 3% year-to-date, which is pretty good, especially relative to all the volatility we've had. The small caps actually outperforming, up 3.9% on a total return basis, which was definitely surprising when you think about all the volatility that we've seen in the smaller caps.
Yeah, and we are holding up, as you say, Katie. Even this week, it's been 2 up days and 1 down day. Bloomberg Intelligence has this market pulse index. I don't know if you've been watching it, but now it's suggesting that sentiment is manic.
Yeah.
And that is actually a little bit concerning, because when that happens, it's a warning sign of a vulnerable market. So just putting that caveat in there.
Yeah, yeah. Manic, not a word you love to hear applied to pretty much anything, but we'll see. We definitely have a manic day of earnings after the bell. It feels like this week has been just so heavy, and Amazon hits the stage later today. The sentiment around big tech has been really mixed, it feels like, especially you think about Alphabet, that disappointment we saw earlier in the week. We'll see what Amazon delivers, currently up about 1% pre-market. We have to wait and wait for NVIDIA, but it'll definitely be good to get the pulse on what we're seeing over at Amazon.
A couple of weeks' time, exactly. But it does feel like the Magnificent Seven have sort of split, right? There was some magnificence about them and some not so magnificent of the 7 so far that I've reported. But as you say, Amazon reporting later today. We're expecting results around 5 p.m. Eastern, I guess. And the stock is up about 7% this year, so not too shabby. Not too shabby, but great point. There is a lot of dispersion in the Magnificent Seven, so you have to be selective. But coming up, we have less than 4 minutes to go until the opening bell. We'll discuss with Banrion's Shana Sissel up next. This is Bloomberg. All right, we are moments away from the start of trading on this Thursday session. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You think about how we ended up yesterday. Of course, that little bit of a lift coming into the close kind of got upset in the after-hour session when we got those earnings from Ford, from Qualcomm. But even still, you can see the futures market right now trying to hold on to this little bit of momentum that we're building right now as we really kick off the trading day. You can see that the bells are ringing over at the NASDAQ, over at the New York Stock Exchange. We're almost to Friday, we're almost to jobs day, but let's take a look at how trading is shaping up just in the first few seconds after those opening bells have started to ring. The S&P 500 higher by about 0.2%. The NASDAQ 100 right now, it's green, but just barely. But the small caps is what I'm really interested in, because the Russell 2000 currently higher by about 0.5%. This is your year-to-date outperformer. I think that stat would surprise many people, especially when you think about the volatility that we've seen at the long end. But even still, keep your eye on the Russell 2000. Let's look under the hood here, though, because we are in the heart of earnings season. And we'll start with Eli Lilly reporting a 2025 outlook that was mostly in line with estimates as it sees growth with Zepbound and also Mounjaro. Bristol Myers also adding another $2 billion to its cost-cutting plans through 2027. Its forecast missed expectations. And then we'll finish up with Honeywell. I got all the decliners here. It's splitting its aerospace, automation, and advanced materials businesses. That follows pressure from activist investor Elliott, which says that the split will boost shareholder value, but shares down a little bit right now, Vonnie. Not quite all the decliners. It appears I have a couple as well, Katie, including Ford. Ford out with a warning that profit may fall by $2 billion or more this year, citing lower car prices and costly new models. Also, of course, the threat of potential tariffs and a slowdown in demand as well for electric vehicles. More on all of that in a moment. But let's also take a look at Qualcomm, because it also is lower today by 5.3% right now amid investor concerns around smartphone demand. The company sees the overall smartphone market flat in 2025. This as it slowly loses Apple as a customer, as Apple develops its own modern chips for the iPhone. So let's take a closer look now at Qualcomm, as well as a look ahead to Amazon earnings after the bell. Bloomberg Technology's Caroline Hyde joins us now. Caroline, explain to me why investors are punishing Qualcomm so much again, because it's another case where we saw revenue rise by 17%, which is not bad, and yet we see this market reaction.
And the overall forecast, Vonnie, is strong. It's just the forecast on smartphone growth is once again just building that anxiety among investors that are worried that we're going to have this continued flatlining of smartphones. Look, it's important about Apple and the fact that they're slowly been moving away onto their own chips. But remember, Qualcomm basically makes money on the IP that are used by any single phone out there, whether you're using a Qualcomm chip or not, you are using their IP. So the royalties keep swimming, and they've managed to do very well at moving into smartphones that Samsung makes, particularly higher end ones, and they make nice royalties off that. But there is just this nervousness. These stocks have risen. These companies are really trying to live up to the hype cycle around the diversification, movement into autos, the movement into AI a little bit more when it comes to the PC element of Qualcomm there. And we saw it synonymous really with ARM, which is, of course, a chip designer. And it's in a lot of litigation versus Qualcomm as well, I might add. But ARM, too, really beat in terms of their earnings. They're pointing, though, towards just a curtailment of the exuberance. We're going to see growth, but maybe just not the growth that many wanted to see when the valuations of these companies are so high.
Yeah, the jitterness, it really just feels like these stocks are being punished if there's even something to
fly on the ointment.
Exactly. Let's talk about Amazon. Amazon, of course, coming up after the bell. You think about specifically in cloud, what we heard from Alphabet, what we heard from Microsoft.
Yeah.
Not too rosy.
It's not. And AWS is the all-important operating profit generator for Amazon. Amazon is the #1 player when it comes to the provision of the cloud. And they need to keep showing that they can live up to the capex that we're expecting to be at least about 70 billion once again. And is that driving return on AI investment? Are we seeing a return on investment when it comes to cloud growth? Now, we're anticipating cloud growth to be strong, but we want to know how strong for Amazon overall. Is it going to be living up to about a 17% growth rate? Are we going to... Remember, they're not seeing the explosive growth rates of a Google or a Microsoft that have been in the 30% realm because Amazon's been doing this for so long. But still, this is going to be the juggernaut that also we question, how is the retail sector? It's interesting that many are saying that Amazon's revenue is actually going to eclipse that of Walmart for the first time. So we go back to the fact that this is an e-commerce giant. And they're going to be affected by Temu and Shein not being able to come in quite so cheaply anymore. The de minimis is going to be axed by the Trump administration. Well, suddenly that's going to be having to be soaked up by the price points of these cheaper Chinese goods. Amazon does have third-party sellers that are Chinese goods, but it's much smaller. And overall, they could win out by being able to get us access to the goods we like, but perhaps not at a higher price point. So Amazon likely to be delivering strength, but we need to see how the cloud does.
Yeah, absolutely. And great point there on the e-commerce business. Surpassing Walmart, that would definitely be a sign of the times. Caroline Hyde of Bloomberg Technology, you can catch her at 11 a.m. Eastern, but don't go anywhere because joining us now, I'm pleased to say we have Banrion Capital founder and president and CEO Shana Sissel joining us now. Shana, great to speak with you again. Let's start with earnings season. Of course, we've gotten a ton of names reporting this week, and it feels like we've seen definite pockets of disappointment when it comes to big tech, when it comes to maybe some more of these industrial names. What is your read-through so far?
Exactly that. Big tech has been largely disappointing. I think I sent over some notes earlier and I said that I think this is going to provide investors an interesting entry point to build a position in names that had been largely overvalued, trading at premiums after their earnings reports. Because long term, I think many of these companies actually have very positive long-term trends. This short-term dislocation, I think, is a result of a number of things. Some concerns about the CapEx spend as it relates to AI and how that's monetized. Some concerns about how other companies and other industries are using their CapEx spend. Concerns about things that are going on overseas, particularly as it relates to tariffs. China, things of that nature. All those things are putting pressure on these names. They're putting pressure on the companies. And the companies, well, if you look at their earnings, they're actually not doing poorly per se. They're just not living up to the super high expectations that we've had for them over the last few years.
It seems like investors have been waiting for management to reassure them about DeepSeek, Shana. And I'm curious because I know you're an investor in NVIDIA. And do you think that it will be when NVIDIA comes and tells us that, you know, DeepSeek is not a threat, that that's when all of these AI-related stocks will rally once more?
I think it'd be hard for NVIDIA when they report earnings, or any of the tech companies when they report earnings, to say that, because I don't know that they have enough information to make that comment right now. I think there's the way that news came out caught everybody by surprise, including those companies. And so subsequently, I think that they still need to do more research, and it would not be in their best interest to make comments related to something they don't understand fully yet, which is why I think you're seeing these sell-offs. Now, personally, I don't think that we should be as concerned about DeepSeek. Every day, more information comes out that makes me more and more confident that it's not the threat that people initially thought it was. Specifically, if you read the actual paper related to DeepSeek, there's a whole bunch of commentary in there that talks about the cost and how the $6 million is not actually reflective of some of the research costs that went into it, so on and so forth. Above and beyond that, the news that came out, I think yesterday, about the Canadian security company diving into DeepSeek chatbot and connecting it to the CCP. So there's a number of things that I think we need to take a step back, but I don't know that we're going to hear from NVIDIA or any of the tech companies in their earnings reports any real significant commentary on DeepSeek until they fully understand what the threat is.
Well, Shana, I want to switch gears here because we're up against the clock, and I want to talk about sneakers because I'm taking a look at your February stock ideas. I see Nike on the list. Nike, obviously a very interesting story right now, and it's down about 25% over the past year. They've had some management shakeups. What is the catalyst that you see coming for Nike?
Well, Nike's becoming cool again. And I think that is something worth noting. I have a 9, soon to be 10-year-old son. He is all Nike all day, every day. And his friends are more and more wearing Nike. You have some celebrity endorsements. The anniversary of the Jordan shoe and the way that they've handled the marketing on that. I love, if you watch on social media, you'll see that the CEO has been handing out tickets to anyone related to wearing the Jordan shoes. And in Chicago, of course, they're celebrating that with, I believe there's blocks on the Jordan statue at the United Center. But they're finding a way to make their brand relevant again. They're going harder into the athlete market. That's always been the thing that's made them cool. The stock is beaten up, and I'm not saying that it rebounds tomorrow, but I think the new CEO is making the right decisions and the right steps to bring Nike back to being cool again. And it hasn't been out of favor that long, and the kids are really the key to brands that like Nike. And if you think about it, the reason they kind of lost ground is because another brand became cool. But I don't think that that's something that's insurmountable that they won't be able to overcome. Stock is cheap. It is beaten up. It's largely out of favor. I love names like that.
Buy them a share of it then while you're at it as well. Shana, thank you so much for joining us today. That's Banrion's Shana Sissel. Coming up, Ford shares plunging after the company warned of a $2 billion profit drop. We take a look under the hood next. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Evercore ISI downgrading Match to neutral in the wake of disappointing earnings. The analyst says that he's less convinced there's a path for recovery. Next up, DZ Bank is cutting Alphabet to a hold. The tech giant reported earnings and sales that missed estimates earlier this week. And finally, we have Voya Financial is getting a downgrade to neutral over at Barclays. The firm cites weaker earnings power and risks to next year's outlook.
And Katie, another stock we're looking at this morning is Ford. It's falling after the company warned of a potential $2 billion profit drop. The auto giant saying lower vehicle prices and costly new model launches are partly to blame. Bloomberg auto reporter Keith Norton joins us now from Detroit. Keith, how did this come as such a surprise that the number was so large? I mean, many of these issues have been brewing.
Yeah, they have. But Vonnie, what happened here is this first quarter profit being wiped out by new model launches really took the street by surprise. Ford is launching a new Lincoln Navigator and Ford Expedition, their big SUVs. They're built in the same plant as the Super Duty pickup truck, which is their most profitable model. So that plant is down for this changeover, and that's why they're going to break even in the first quarter. That really takes a big hit to overall earnings. They say they'll be stronger in the second half.
Well, it's hard to talk about Ford and automakers without talking about tariffs. And CEO Jim Farley actually joined us on BTV last night. Let's take a listen to what he had to say on the topic.
I think longer term is the bigger concern. These kind of tariffs, especially in these two countries, are very significant. And if they persist beyond months, we could see billions and billions of dollars of pressure on the industry, lost jobs, lots of impacts to communities and our ecosystem in the industry. And that's what we're talking to the administration about and congressional leaders.
And Keith, it just seems like sort of an impossible situation, because if you're Ford, if you're GM, and you're watching the will he, won't he on tariffs, whether or not it's a negotiating tactic by the administration, you still have to try to run a business around that possibility.
Right, and it's very hard to manage around that uncertainty. Jim Farley made another interesting point, and that's if you tariff Mexico and Canada, you allow Ford's European and Asian competitors to import their vehicles without tariffs. And he said that would lead to a bonanza for their foreign rivals because they wouldn't have that 25% levy on their cars coming into the country.
Is there a possibility that car prices, though, will actually go up, Keith, for some of the reasons just mentioned, and that might offset some of this $2 billion? Or will customers just not buy the cars if they do become that much more expensive?
Well, to raise prices to cover a 25% tariff would make the cars uncompetitive from a price standpoint. So they wouldn't really benefit like they did during, say, the pandemic with the supply shortages from the higher prices in that case, because volumes would definitely go down.
And Keith, I want to take a longer term look at Ford, because you take a look at this stock, obviously falling out of bed this morning. It's had a really rough ride over the past year, over the past 5 years. It's still up about 14%, but relative to the rest of the market, obviously not doing too much there. Is it crazy to think that this could be an activist target, or how do you see that potentially playing out?
Yeah, it's always hard to think of Ford as an activist target because the Ford family still controls the company through a special class of stock that gives them 40% voting control. Bill Ford, the great-grandson of Henry Ford, is the chairman of the company. His daughter is on the board. His nephew is on the board. The family is still firmly in control of Ford, and as long as they have that stock, it's very hard for an activist investor to come in.
Keith, thank you so much for all of your insights. That is Bloomberg's Keith Naughton there in Detroit. Coming up, has PIMCO lost its edge when it comes to private credit? We'll discuss in today's Wall Street Beat. This is Bloomberg.
All right, it's time now for the Wall Street Beat, and PIMCO's hesitant dive into private markets could leave the company at risk of falling behind. Bloomberg's Laura Benitez has the scoop. Of course, this is the subject of today's big take. And Laura, I have to admit, when I think of PIMCO, I don't necessarily think of alt. I still think of Bill Gross, even though, of course, it's been years and years since he left the company. How has PIMCO changed over the years since his departure?
I think many people still do think of him. He's a figure that's always looming large. His spirit lives on. But I think people generally feel like it's gone from having this one hawk-like figure to PIMCO now being governed by a smaller circle of leaders. But of course, the biggest divergence in the last 10 years has been PIMCO's desire to expand into alternatives, which, as we know, pays very high fees, and so many investors are flocking to that part of the market now. So there's a lot to capture, a lot of opportunity.
Yeah, Laura, give us a little bit more detail on how PIMCO's alts business has developed over the last few years.
Well, I mean, it's been handed a 90 billion mandate from Allianz back in 2020. So, its alternatives business is around 200 billion. Half of that is with real estate from Allianz. So it has been quite heavy in property. Obviously, property's had a lot of challenging moments over the last 2 to 3 years. So there's been a lot of working out there, some losses and some departures. But they have been very strong in places like distressed debt, where they have a presence in these big capital structures. They're in the steering committees of a lot of these deals if they go a little bit awry. And, there's some very, very sharp minds there, as we know.
Laura, give us a sense of the competitive landscape here, because it feels like every asset manager is trying to get its alts business up to speed. You think about PIMCO in comparison to BlackRock, for example, which has done a ton of acquisitions, it feels like, over the past couple of years to really come up to scale. How does PIMCO compare?
I think, managers have a few choices. One is to try and expand organically, which is very, very slow. And, it can be part of the longer game strategy. Another side is, you can try and acquire, which is what the likes of BlackRock have done. That can be very costly, and many firms don't want to risk diluting or changing their culture or structure internally. So there are challenges to both sides, but what's really key is attracting talent and keeping that talent at the minute, because there's a lot of competition for hiring in that market.
Yeah, exactly. So what does it do to retain that talent, given that there's obviously a little bit of a problem still? Before it was Bill Gross, now perhaps it's Dan Iveson and a few of a small coterie?
That's right. Yeah, I think, incentives are very key. When you have the likes of KKR and Apollo, Dan's made some very, interesting incentives and opportunities. And I think, other managers have to step up to that and be mindful of that. And also just have a great, healthy, constructive culture and strategy going forward in terms of, being aligned on how you build out that alts business. But we've seen many partnerships start to crop up amongst the more traditional asset managers. So we've had KKR partner up with Capital Group. BlackRock, as you mentioned, have been expanding at breakneck speed. Big acquisition for HPS, that's still in the mist. So it'll be interesting to see how other managers try and move in and stay competitive.
Let's talk about fees here, though, because a line that caught my eye in your story is you talk about PIMCO's relative caution carries a risk here of it getting stuck as a lower margin bond shop. And underlying part of this gold rush into private assets is the fact that, of course, you can charge investors higher fees to get that exposure. So talk to us about, what that actually looks like when it comes to the end investor buying into a private credit sort of fund versus just a traditional public bond fund.
Exactly. So the majority of PIMCO's assets are with fixed income. And as you know, there's a race to the bottom in terms of fees. They're just getting lower. The likes of Vanguard and others are keeping everyone on their toes. Whereas obviously in the alternatives part of the market, you can charge some very, very attractive fees for doing more bespoke, interesting, complex, higher risk strategies. So I think that's something that everyone is, keeping in mind. And also for the traditional asset managers like PIMCO and Capital Group, it'll be keeping both sides happy, keeping your traditional investors happy, and also, looking at how you can kind of push into the higher fee part of the market. So there are some challenges, I think, for the bigger managers that have been around for a long time.
All right, Laura, great story, great reporting. Really appreciate your time this morning. That is Bloomberg's Laura Benitez. And Laura mentioned, of course, that race to the bottom in fees. And speaking of, I'll be in conversation with the CEO of Vanguard, Salim Ramji. That conversation coming up at 11:30 a.m. Eastern. Of course, Vanguard announcing its record fee cuts this week. So plenty to talk about there. But let's get a check on these markets right now. You can see the S&P 500 holding on to its gains, up about 0.2%. Big tech managing to find some momentum here. The NASDAQ 100 higher by about 0.2% as well. I was talking about that leadership in the small caps, faltering a little bit right now. You can see the Russell 2000 pretty much unchanged here, but that has been your year-to-date leader. A lot of that depends on the bond market, and the bond market, of course, is where all the eyes are right now, especially when it comes to the Trump administration. And Scott Bessent, our newly installed Treasury Secretary, Bloomberg will speak to him at 1 p.m. Eastern. But coming up in the next hour on this show, we'll speak to Citi Wealth's Stephen Wieting. Then we'll speak to Cummins CEO Jennifer Rumsey on her company's promising growth. And then the CEO of Labcorp talks about how RFK Jr.'s potential confirmation may impact business. This is Bloomberg. All right, we are 30 minutes into this trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Bonnie Quinn. Matt Miller and Sonali Basak are off.
And coming up, stocks rising as investors brace for tomorrow's jobs report and sift through a flurry of earnings. Amazon takes the spotlight after the bell today. And as earnings season rolls on, we'll get the view from the C-suite. This hour, we'll speak to the CEO of Cummins as well as the CEO of Labcorp. And it's yields, not the Fed. Treasury Secretary Scott Bessent says that the administration's focus is on the 10-year Treasury rate. Bessent joins Bloomberg today at 1 p.m. Eastern. All that and more coming up. Let's get a check on these markets. A little bit of a rally on our hands. The S&P 500, the NASDAQ 100, a little bit higher to the tune of 0.1 to 0.2%. The bond market relatively well behaved right now. Scott Bessent will be pleased to see that. You can see the 10-year Treasury yield up about 1 basis point or so. We're hanging out near 440. We certainly have cooled from heights that we've seen in the past couple of weeks. So let's wrap it all together now with Steve Wieting. He is Citi Wealth Chief Investment Strategist and Chief Economist joining us now. Stephen, it's great to have you with us.
Thank you.
It's been a heavy week. We've gotten a lot of trade news. We've got a lot of earnings news. We've got a lot of economic news as well. So let's start with tariffs, because one of the things that we came into this week worried about was the possibility of a multi-front trade war. And from the investor perspective, how do you prepare a portfolio for that possibility?
Well, this is a critical issue. Trade is highly profitable for American firms. We have a trade deficit, but we have a market cap surplus. If you take a look at the U.S. valued at 2/3 of the global equity market or a bit more. So the question is this going to be something that's going to actually disrupt production? Is it something that's going to create great retaliation? Certainly, we're taking a little bit more of a diversified approach in portfolios, emphasizing a bit more income than just the positive aspects of what we're seeing from the administration. Deregulation and clarity on taxes, which are all positive. It's causing a rise in business confidence. But tariff risks are meaningful. I think what you saw, though, with Canada, Mexico, Colombia, all willing to give concessions to avoid tariffs is a sign that this does not have to be a disruptive shock.
Which would be a relief to the markets in many, many ways, right, Stephen? But we won't know for at least a month if there's going to be another extension or some other form of wrapping up of this whole, idea of tariffs and whether they should go on or not. And I guess the threat will always be there. Talk to us about what Scott Bessent has been trying to steer the conversation towards. Obviously, once an economist, always an economist. Is it doable? Can a government impact the yield curve lower?
Well, look, the shape of the yield curve is going to be heavily influenced by the Fed. Every Fed easing cycle has resulted in a steeper yield curve. Every Fed tightening cycle, a flatter yield curve. And the mere fact that the Federal Reserve has gone into a hold pattern to assess has in fact helped and assisted to lower those longer term yields. The fact that the Federal Reserve cares very, very much about in the long run hitting its inflation target. And even if that costs us something in the near term, that's good for 10-year treasuries, right? And that's why we've seen the yield curve flatten back a bit and yields back off of 480. We think that the Fed will also be very sensitive to the labor market. What you saw out of the JOLTS data, what we would expect that by mid-year we'll start seeing again is that the labor market will underperform the economy. Labor demand is cooling down some. It's not a collapse in the economy by any means, but the Federal Reserve backed off 100 basis points just on that prospect. So we think that they probably will be easing again some.
Yeah, for sure. And I'd love to get your forecast on that. But I'm specifically talking about Scott Bessent's comments, and that's absolutely independent, or should be, of the Fed. Can the U.S. government, via the Treasury, impact the 10-year?
I don't think it is. Again, the choice of particular borrowings, whether it's bills, whether it's tens, and this focus can probably have a minor influence on what is a massive market with global participation. And of course, in an extreme way, it could influence the yield curve. But U.S. monetary policy is going to have a very big influence at both ends of the curve and how the Fed conducts monetary policy, where we are relative to the rest of the world. That's all highly meaningful beyond just issuance data.
Yeah, no, it is interesting, of course, to see his comments come out last night after we got the refunding announcement earlier in the morning. I don't know if you can draw a line between those two, but I know that some people are. But let's talk about this idea that, okay, this administration is seemingly very focused on the bond market. And you think about the first Trump administration, it seems like the focus was on the stock market, on the S&P 500 and the number there. And there's been a lot of question marks about the Trump put, whether it still exists, whether the strike price is much lower than it used to be. I mean, how do you think about that? Obviously, you're a long-term, well-diversified investor. I mean, does it matter to you either way whether or not the president of the country is focused on the stock market or the bond market?
Well, look, we have to admit to some guesswork here. And the fact that there has been a financial market reaction to tariffs, may have some feedback effects on what the administration chooses. The fact that we lived with 2 years of average 7% inflation, probably has some influences on what exactly the U.S. will pursue. And, what will really please the public? It isn't necessarily, again, the highest tariff level, the highest domestic manufacturing content. That may not be exactly what the public is after. I think that there are real questions here that we don't have answered yet, and maybe the administration hasn't come down to a final decision. When you take a look at tariffs, and you think about this large budget deficit that the U.S. has, this fairly extreme budget deficit. Now, again, there are plenty of them around the world, but how would we address this? How would we address excess demand in the United States being driven up by a budget deficit? And a lot of economists will tell you what you need is tax increases, right? That would slow demand. It wouldn't leak out abroad. You would lower the deficit. You'd have a smaller trade deficit and budget deficit with tax increases. You could take a look at what tariffs do. It's an attempt to raise revenue, much like a consumption tax, but to discourage foreign imports and to encourage domestic production. I think that they're thinking about it partly that way, but also very much about all sorts of trade aims. So border control, the administration is focused in on Mexico, and the administration's focused in on Europe paying for defense. So it's using tariff threats for all of these sorts of things. So there's some expectation embedded in markets and some of the volatility that we've had that have been driven by tariffs. If you think about tariffs on Mexico and Canada, if they went through, we could collect $260 billion, but that's very far from something that would wreck the economy.
Stephen, thank you so much for your thoughts today. Very much appreciated. That is Stephen Wieting of Citi Wealth. Now let's get a look at stocks moving at this hour. Bloomberg's Jess Menton joins us. And Jess, we're starting off with Roblox.
This is a pretty significant drop here. So it did drop as much as 30% in pre-market trading. It came off of some of those lows, but still nonetheless, still down 17%. So it's on pace for its worst session since May. But if you put that into perspective with market cap, I mean, that's wiping out around $8 billion at this point right now, if that holds through the close. And right now its market cap is around $41 billion. So what happened here, it's active users specifically for the fourth quarter. Was expected to come in, those anticipations from especially what analysts were thinking of, around 88 million. It actually was around 85 million. And of course, there's been a lot of questions about the security when it comes to the video platform in recent quarters too, and what they were doing with AI and protocols for their younger users, especially what parents were kind of pressuring it. So right now you're starting to see that, and especially the growth is beginning to slow here, and you're really seeing that pressuring the stock.
Yeah, big time. And it really feels like an embarrassment of riches when it comes to big movers today.
Right.
One of those big movers is Peloton. Peloton has been such a fascinating story. Finally got some good news.
And of course, as we know, it's one of those pandemic darlings that has not been able to take out that high that we did see back in January of 2021.
Victim of its own success.
Of course, so it's still down about 90% and more than that since that all-time high a few years ago. But if you're looking at this, up about 13% on pace for its best day since October. Actually, its guidance, particularly for the next year, was better than expected. And then also specifically, because this is for the holiday quarter, they have partnerships with places like Costco. And so that's something that helped drive sales. So you are seeing some optimism there, but still there's a lot of cost cutting and question marks as far as what this means moving ahead.
Well, a uniquely American company, and that's Ralph Lauren. It's up nearly 100%, by the way, year over year, up 25% year to date. Explain to us what's going on with those shares today, up 15%.
It is, and it's interesting because if you're looking at European fashion outlets, especially like Hugo Boss, they're not seeing the same type of growth here. So particularly in the holiday quarter, they saw a lot of growth with younger shoppers here. So when you're thinking, of course, Polo brand is one of the bigger ones that people notice for, as well as when it comes to sort of the Purple label as well. And then especially if you're just looking at the apparel group in the S&P 500 right now, that's higher. But I have to point out, because Tapestry also reported, and especially because of its Coach brand, you did see that moving higher too in that group. So that's actually up around 15% for Tapestry specifically, on pace for its best day since May 2022.
I'm still stuck on Ralph Lauren. Those are some crazy numbers.
They really are.
Yeah, geez Louise. It feels
Do you tend to buy Ralph Lauren?
Not really. I just wear leggings all day. But it almost feels like another Abercrombie, another retailer that is just popping off right now.
And especially with that's a tell on the economy. If shoppers are still willing to go spend money at the more expensive type of brands.
That's true. You can't paint with a broad brush here. There's a lot of idiosyncratic stories. Jess Menton, great stuff as always. That is our equities reporter, Jess Menton. Now, coming up, shares of engine maker Cummins are also on the rise this week. We'll speak to the company's CEO and chair, Jennifer Rumsey, up next. This is Bloomberg.
Now to high interest, a look at what's making headlines around the world. Google is the latest company announcing changes to its diversity hiring plans. According to an internal memo, it said it's reviewing its programs and would no longer have, quote, aspirational goals tied to representation. It joins Meta and Amazon in big tech's retreat from DEI initiatives, which have been rejected by President Trump's administration. Chinese retailers selling goods on popular platforms Temu and Shein have been slapped with a 30% levy. The vendors received the news about the new prices last night. The added stress comes as the US Postal Service flip-flops on inbound international packages from China and Hong Kong. Warner Music Group and the streaming music giant Spotify unveiling a new multi-year collaboration today. The companies will work together to provide a deeper music and video catalogue. The agreement will also expand paid subscription tiers and introduce new content bundles. Financial terms of the deal were not disclosed. Katie.
All right, let's switch gears here now to Cummins, because President Trump's tariff threats loom large over manufacturers who source at least some of their raw materials and components from international suppliers. Here to talk more about the potential impact, I'm pleased to say we're joined by Jennifer Rumsey. She is the CEO of Cummins, which of course is a global engine maker. Great to have you with us. Obviously, the top concern probably for investors right now is tariffs. So if you could give us an idea of what Cummins' exposure to Mexico and Canada looks like and what steps you're taking to maybe diversify that supply chain would definitely be interesting.
Hi, Katie. Great to be back with you. Let me just start. We announced our Q4 and 2024 results earlier this week. And so I just want to start by thanking our 70,000 employees around the world for delivering record revenue and profitability for Cummins. And, our products are performing really well in our global markets. We're really pleased with how we're doing. And despite some softening in one of our historically most critical markets, North America heavy-duty truck, we saw growth globally and in really strong demand in markets, most notably our power generation market. And our strategy really is about making products in the markets where we're selling to our customers. So our engines and gensets that we're selling here in the U.S., we're making here in the U.S. As you noted, we do have material and some of our components that come from outside the U.S. and Mexico, most notably. So while we're well positioned with our product manufacturing footprint, we are concerned about blanket tariffs and potential retaliatory action that might happen in these U.S. and Mexico tariffs, and want to make sure that U.S. companies are competitive internationally and that we don't drive inflation into the U.S. while also focusing on creating a strong U.S. economy and jobs here.
Given your dependence on Mexico, then, Jennifer, have you done anything yet to diversify your supply chain geographically, let's say, or, do anything because of the back and forth?
Yeah, so Cummins is a global company. As I said, we're making in markets around the world. We leverage the scale position that we have. I think every company in recent years has really been focused on supply chain resiliency because of the disruption and the geopolitical world that we're living in. That said, when you're a large-scale manufacturer, it takes multiple years to make some of these shifts, and we need to be able to stay competitive globally, leverage that global scale. And so having stability and clarity on what's going to evolve is really important for Cummins, for our customers, and on our industry.
Well, Jennifer, and I promise we'll move on, but are you taking any pricing actions or thinking about any pricing actions that you could take around the possibility of tariffs? We were talking about this earlier with one of our autos reporters that even if these tariffs are being used as a negotiating tactic, I mean, you have to manage a business around that possibility.
Yeah, certainly we have to manage our business while we would work to offset any impact. If we do see sustained tariffs, we'd have to pass those costs on to our customers, which is why the concern about inflation and the impact on the U.S. economy.
So difficult to foresee and forecast. What about regulations, Jennifer? There's supposed to be new heavy truck emissions regulations coming in and also additional greenhouse gas rules coming in, all by 2032, 2027 in the former case. Do you anticipate any of those might get rolled back? And is that impacting any decisions you're making right now?
So Cummins has a long history of actually embracing change, including change driven by regulation, as a way to innovate and grow our business. And we think it's really important that we invest to meet our evolving customer needs. And we're continuing to do that and invest at record levels. And so part of that is our strategy we call Destination Zero, which is focused on decarbonizing. Now, our approach is to invest in a range of products. We understand the transition will be long, will be messy, and we're really evaluating when we bring new products to market based on how things are evolving, regulation, infrastructure, incentives that help customers start to adopt this. The nearer term regulations that we're facing here in the US, which go into place in 27, we believe will largely stay intact, but that we will be looking at evaluating CO2 regulation, and there are concerns about affordability and infrastructure around those. And as we have always done, we embrace the need for change, meet our customer needs, and work with regulators proactively to help them understand the issues, the opportunities, and how to make appropriately clear standards that our industry can invest over multiple years to meet.
So we'll definitely keep an eye on that one. I do want to talk a little bit about some of your end markets, of course. Like we said, Cummins, obviously a major engine maker. What are you seeing when it comes to demand for trucks, the transportation industry overall? And are you seeing any signs of weakness potentially?
I mean, overall, I'd say the products that we have out in the field are performing really well, and the customer pull for those products is very good. We have seen some softening in the U.S. heavy-duty on-highway market, really in the second half of 24. That market for us and our truck customers held up pretty well because of the large back order that was built up through the supply chain challenges that we faced a few years ago. But we've seen some softening. We think first half for our on-highway markets is going to continue to be softer, and we're prepared for that, and then for that to strengthen as we go into the second half of the year. But our power generation business, which is impacting both our power systems business as well as our distribution business, remains very strong. This demand for data center backup power, which we're very well positioned to provide with our products, continues to grow, and we're investing in capacity and new products for that market.
So it doesn't sound like you're seeing any signs of demand plateauing there. What about China, Jennifer? Have we seen the trough in China?
Yeah, our outlook for China for this year is to be slightly up. It's been a weak market over the last couple of years. There has been some stimulus that's gone into that. And so we believe that as we come back from the Chinese New Year there, that we may see some uptick in the on-highway market in China. And then, like we see in the U.S., really strong demand for our power generation products.
All right, Jennifer, that's a good place to leave it. Great to get some time with you. That is Cummins CEO Jennifer Rumsey. Now, still ahead, a Waffle House egg surcharge is ruffling a lot of feathers. We'll have the details next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, we have Hershey's projecting a sales increase this year despite higher commodity prices. Hershey, of course, has been faced with record high cocoa costs for over a year, forcing price increases. Shares currently up about 4.7%. Next up, we have Starbucks placing some limits on its mobile orders in an effort to reduce the workload of baristas. It's part of a broader plan by CEO Brian Niccol to speed up the service. The coffee giant also trimming about 30% of its menu. We'll see when that starts to pay off. And finally, let's talk about the 24/7 dining chain Waffle House is adding a 50-cent per egg surcharge to the menu as the bird flu outbreak causes prices to skyrocket. The Agriculture Department predicts that egg prices will soar another 20% this year. You think about Waffle House and you think about getting an omelet or something at Waffle House, how do they count the eggs? Because you sort of just put it all together. I'm pretty sure they have a big gallon of eggs that they just pour out.
It's a great point. They must have an egg cracker and those egg bird sorters in the back. But did you hear about the 100,000 egg heist that just happened in Pennsylvania?
That did not come across my radar.
Panic buying in Pennsylvania and across the country as bird flu really does get rid of more and more roosters roosters and hens and all of these birds that have the ability to lay eggs. Actually, it must be hens, right? The hens lay the eggs. Anyway, I guess there's been this, this heist in Philadelphia where 100,000 eggs have gone missing. But, I mean, they need refrigeration, so...
That's the thing. It's not shelf stable. So even if you steal the eggs, you have to have some plan for how to store them. But...
Exactly. You would think that the authorities would be trying to crack the case.
Crack the case. Oh. Jeez Louise. Just terrible.
That was terrible.
Yeah. Eggs a hot commodity, though. They're, I don't know, precious. Anyway, let's get a check on these markets. You can see we're a little bit higher today, but we have a great conversation coming up with the CEO of Labcorp next. This is Bloomberg. Well, lab services giant Labcorp reporting strong earnings earlier today as diagnostic testing demand ramps up. Labcorp CEO Adam Schechter joins us now. Adam, great to have you with us. Let's just set the scene here, because we think about your business. You have traditional diagnostics, and then you also have biopharma services. So just give us a quick overview of what the outlook is in those two markets.
Absolutely. Katie, it's a pleasure to be here with you today. So we reported our fourth quarter results today, and we also reported guidance for 2025. And as you said, we have two parts to our business. We have our diagnostic testing business, which is the largest part of our business. And then we have biopharma laboratory services, of which there's two parts. There's a central laboratory global business, and then there's an early development research laboratory global business. As we looked at the fourth quarter results, each of those businesses grew at least 10%. Diagnostic revenue grew 10.2%. Central laboratory revenue grew almost 10%. And if you look at our early development business, it grew 12%. As then take it into 2025, the guidance that we provided shows overall growth across Labcorp, across the segments, of 7.5% for revenue. And then we also gave, that's at the midpoint, we also gave a midpoint for EPS, which would represent 10% growth. So a very strong profile looking at 25.
Yeah, many acquisitions this year. In fact, Adam, you also acquired assets from Invitae to bolster capabilities in genetic testing. Just curious as to whether you could talk about what specifically you're going to have to do in order to drive profitability in that business. What will you have to do between the first half and the second half?
Yeah, so if you look at our diagnostic business, we showed tremendous growth. About half of the growth came from organic growth. The other half of the 10% came from inorganic growth, came from acquisitions. We did 10 acquisitions in 2024. Many of those were hospital or local regional laboratory acquisitions where we acquired the labs or the outpatient services. But we also did acquire a company called Invitae, which does genetic testing. If you look at Invitae, the revenue grows very well, but it wasn't very profitable. It wasn't, frankly, profitable at all when we acquired it. Bringing that into Labcorp, we'll be able to make it profitable. We expect the revenue for Invitae to grow at 10% per year, and we expect it to be accretive to earnings in 2025. If I look overall at the strategy, though, that's what's most important. Strategically, there's 4 areas that we're really focused on: oncology, women's health, autoimmune disease, and neurology. Each of those 4 areas, there's huge medical unmet needs. There's a lot of advances in biology and science, and we feel like we can make a significant difference there. Invitae is very strong in genetics, but also in oncology and women's health. So we think that it really adds to our strategy and our focus.
So it's interesting. I mean, you're talking about the 10 acquisitions that you completed in 2024. I take a look at your closest peer here, Quest. They also have been pretty acquisitive as well. And just from an industry-wide perspective, I mean, what is driving that sort of activity, and how much more runway basically do you think there is?
You know, it's interesting. If you look at Labcorp and you look at our market share in the market, it's still very small. It's only about 10%. And if you put the 2 largest laboratories together, they still represent a very small fraction of the overall diagnostic market. Hospital systems represent a very large part of that market. I think after COVID, hospitals realized that running their laboratory takes a lot of capital, a lot of expertise, and that we could probably do it better than they could. I think that's what's led to a lot of hospitals wanting to do partnerships or deals with us.
And Adam, I also want to talk about bird flu. We were just talking about it through the lens of egg prices, which have just been off the charts. As I understand it, you introduced a bird flu test recently. You worked with the CDC to do that. Just give us some color there around what that would mean for your business and what the demand looks like for that test.
Yeah, sure. Now, we have a very broad range of tests. We have over 6,500 tests available on our testing menu. If you look at things like flu, COVID, RSV, add bird flu to it now, those are typically seasonal. We don't think of any one test as an area of great growth opportunity. We look at the portfolio of tests and being the lab that can provide whatever the physician is looking for that patient as the reason that we're so successful. As I look at bird flu, it's not a significant amount of our tests as we speak, but we're prepared just in case we need to be for the future.
Yeah, we'll certainly see how that one develops. And I am curious, I mean, when it comes to your business, like you said, it's all about the portfolio. What does the decision-making process look like when it comes to adding a capability, when it comes to adding a type of test? Are you looking at, number of cases, or just take us into that process?
Yeah, so, we typically bring to market between 85 and 100 new tests every single year. And we look for medical unmet needs. We look for where we can add the most scientific value. Typically, if there's a medical unmet need, therefore, the test will be utilized over time. So it really starts with science and technology, and the profitability, frankly, follows.
All right. Adam, thank you so much, and congratulations on another quarter and on the Raritan, New Jersey expansion. That is Labcorp CEO Adam Schechter. Let's get a look now at stocks moving at this hour with Bloomberg's Jess Menton. And Jess, I just noticed it a little time back, Yum Brands crossing the wire. Tell us what they said.
And so this is the company that owns Pizza Hut and KFC, but in particular, it was Taco Bell that was helping drive sales in the latest quarter. And it's interesting, too, because when you're looking at this, that stock's actually just a little over 1% from its all-time high that it last reached in April of last year. That's why it's important to keep an eye on. It's up about 8% today, on pace for its best day since April of 2020. So looking at those sales turning positive, and also this is an inflation story, because when you think about recent quarters, especially at the start of last year, it still was feeling that inflation print when you're thinking about the pressure, especially consumers and shoppers and people going to eat at a lot of these restaurants. So that also is a more positive sign for this type of company moving forward.
Yeah, really interesting to see the stock popping about 8% today. Let's also talk about Philip Morris hitting a record, I believe.
It is.
The kids love Zyn. What's going on?
They definitely do. So the Zyn that you're pointing out, that's the patch, the nicotine patch. And that's what's driving things too. So I want to point this out too, because the consumer staples sector that obviously Philip Morris is housed in, that's the best performing sector today. It's up about 0.7%. So helping it give a lift, even though we're seeing some other pockets of consumer staples lower today. So as to your point, it is the smokeless tobacco products that were driving its gains today.
And of course, then there's Honeywell, and it was kind of that 1-2 punch, right? So they finally sort of made it clear that they were actually splitting up and into 3 portions, not 2. But then those earnings caused the stock to drop.
It was, especially when you're thinking about its guidance falling short of that estimate. But of course, now that Elliott Investment Management, they were basically pressuring in recent months, especially in November, because at that point, that's when Elliott revealed a $5 billion plus position in Honeywell. And that was actually its largest ever in a single stock. So you are seeing Honeywell, the ticker symbol is HON, down more than 5% on pace for its worst day since July 2023. So when you're thinking about its aerospace division, what's happening with its advanced materials arm, as well as when you're thinking about what's happening with its automation business, that's what the key driver is here. And especially because when you have that activist investors pushing it, they're hoping that potentially there could be more, especially when you're thinking about what shareholders are pressuring and want from that. But it obviously remains to be seen what this could mean for this type of stock moving forward.
Yeah, it definitely will be fun to follow. Jess, great stuff as always. That is Bloomberg's Jess Menton. Now coming up, forget the Fed. The administration wants to focus on 10-year yields and bringing down borrowing costs. Wall Street Week's David Weston gets insight on the U.S. debt problem with Bridgewater's Ray Dalio next. This is Bloomberg. Well, time now for our daily Wall Street Week conversation. And how do you solve a problem like America's ballooning debt? Treasury Secretary Scott Bessent says that the answer may lie in 10-year Treasury yields. Bloomberg Wall Street Week host David Weston sat down with Bridgewater Associates founder Ray Dalio to talk about the problem.
Bridgewater founder Ray Dalio has written a new book, available at no charge online, addressing the U.S. debt problem. It's called How Countries Go Broke. And he starts with how much the U.S. is going to have to borrow and who will lend it the money it needs.
The difference is they can print money. And then that's basically it. So what you have is a situation where there's a supply and a demand for debt. As we have a new supply, that will equal in the United States now, by the way, this is a problem elsewhere too, but it's about 7.5% of GDP. So the supply of debt is going to be large. That's new debt. If I calculate also who are the buyers of that debt, and that there's not going to be enough demand for that debt. It doesn't look like there'll be enough demand. And the way that it works, so there's two things to keep in mind. There's supply and demand, and then what do central banks do, or what do the governments do when they don't have enough demand? Central banks come in and make up that demand. They essentially print money, and then they buy that. And then that has a consequence. And so just like in 2020, 21, we went through, they needed to give money away, and the government needed to borrow, and the central bank produced the money and bought that. That devalues money, raises inflation, and so on.
Thus far, the United States has been able to support ever-growing debt and deficits because of that ability to print money. But Dalio warns that, throughout history, countries have run up against the demand of creditors sooner or later to get paid.
It is when the owners of that debt, we have, over $36 trillion essentially of government debt, when they start to also fear that it may be monetized, like the Japanese. Japanese is a very good example. Japanese, if you have terrible investment to own bonds, they didn't go down in value, but you got an interest rate that was 3% below another interest rate, U.S. interest rate by example, and the currency depreciated by 3.5%. They were losing 6.5% a year for many, many years. That's what it can be like. Of course, there's an inflation component that enters into the depreciation. One of the things I also want to emphasize is people pay too much attention to depreciation against another exchange rate. Normally at such times, many countries have this issue, and they don't want their currency to depreciate. So what you see is the depreciation of all currencies in relationship to things like gold or other assets, and that's where you have to pay attention to it.
And that, of course, is Ray Dalio speaking with David Weston, who joins us now. And David, a really interesting and timely conversation on the deficit, especially when you layer on what we heard from Scott Bessent yesterday. We'll hear from him again today on Bloomberg Television.
And Ray, I think his book is quite timely given the discussion we're having right now in Washington. Scott Bessent's talking about what we're going to do with the debt and deficit, because most people think we can't keep going. Scott Bessent has said he talks to Donald Trump regularly, and Donald Trump is concerned about it. And to some extent, they overlap, Scott Bessent and Ray Dalio, on what needs to be done, because in his book, Ray Dalio says we have to do whatever it takes to get our annual deficit down to 3% of GDP, which is a 3% number, as you know, that Scott Bessent adopts as well. Mm-hmm. They have somewhat different ways of getting there as a practical matter, but they basically agree on that core goal.
So right now, the deficit is about 7% of GDP, which is obviously double, more than double what they would like. At the same time, it's not out of control, and it is the United States of America. Do we really need to worry about the deficit? Do we really need to worry, as Ray Dalio says, that we'll run out of buyers?
Well, you have to understand his analysis. It's the way he looks at things. As you know, he looks over long periods of time at macroeconomics. And he says there are long debt cycles. This one started in 1945, he says. And as he looks around the world over hundreds of years, sooner or later, you do have to produce too much cash, too much currency, and it depreciates it, and something has to happen, and there has to be a break. And he thinks actually we're getting close to that point if we don't take some pretty substantial action. As I say, Scott Bessent agrees with him on that point.
Yeah, well, so they agree there, but talk to us about the different approaches they would take to get to that 3% level.
Well, Scott has his 3-3-3 approach. He wants 3% growth, 3% more oil production, and he wants 3% of GDP deficit. Scott thinks we can get there through cutting costs, really cutting some spending from the government, as well as supply stimulation. Ray says, I don't care how you get there, but you're going to have to raise taxes as a practical matter. That's something that Scott Bessent does not think we ought to do. He does, Ray, focus on the interest rate, because you have to understand, we're making it worse as the interest rates go up, because that means we have to pay more money on the debt that's outstanding, and sort of a vicious cycle. You got to get that interest rate down in order to not pay as much in interest. And that's, I think, what Scott was saying yesterday, the Treasury was saying, we have to really focus on the yield on the 10-year.
So I suppose if there's anywhere where they agree, that's where it is, right, David? But it's not as easy done as it is said.
Well, and Ray, in his book, he goes through a lot of analyses, as Ray tends to do. He goes through cutting government spending to get down to a 3% annual GDP deficit is going to be just about impossible. I mean, he thinks in order to get to that number, for example, if you wanted to divvy it up, it would be 4% cut in spending and a 4% increase in tax receipts in order to get there. They have to do both of those things together. And if you take away the tax receipts, that means you really have to cut government spending rather dramatically.
And before we let you go, David, I do want to talk a little bit about the Treasury refunding announcement that we got yesterday, because Scott Bessent had been critical of the way that Janet Yellen sort of set up these debt sales, but largely stuck to what she's been doing.
At least for now.
Yeah.
I mean, I read that as well, and I was curious about that, because Bessent had been saying, goodness gracious, she really has been loading up on short term and really not buying long term in order to keep that yield down. By the way, Larry Summers has been saying that on our program, Wall Street Week, for years now, saying, why didn't they take on long-term debt at low interest rates? But I think most people thought, even if Scott Bessent wants to get to a different balance in the term, he can't do it right away. It would cause such shocks that it's going to have to happen over time. So we'll see over time whether they start making adjustments in the long end versus the short end.
Yeah, investors already have a lot on their plate. Maybe we'll wait when it comes to terming out the debt. But David, great stuff as always. That is David Weston. And Treasury Secretary Scott Bessent sits down for a live interview with Bloomberg's Saleha Mohsen at 1 p.m. Eastern. So that's today. And then on Friday, you can catch Wall Street Week at 6 p.m. This is Bloomberg.
Senate Republicans are breaking with the House over budget legislation to carry out President Trump's agenda. The newly announced plan would delay action on tax cuts until a second budget reconciliation package is passed. The president is meeting with Republican lawmakers shortly to discuss a resolution. Joining us now is Balance of Power co-host Callie Lines. So, Callie, what will he say to Republicans this time round in order to perhaps sway some minds that he wasn't able to say up to now?
Well, Vonnie, it's going to be a question of whether President Trump actually takes a firmer stance on how procedurally he would like Congress to proceed with his legislative agenda. Because while he has expressed support for what he has described as one big, beautiful bill, the idea that you do everything he wants to achieve from the border to energy to tax policy, all in one big reconciliation package, he has suggested on multiple occasions that really he's open to either as long as it all gets done. So will the president put his foot down specifically when it comes to hardline conservatives in the House, who are really the ones who are delaying this process, if you will, demanding larger spending cuts, which is what has stalled a budget resolution, which is the first step in this process. And that is why, because of the difficulty in the House, the Senate looks like it may try to move first here. As you alluded to, Vonnie, Lindsey Graham, who chairs the Budget Committee in the Senate, is out with a new plan that would be about $300 billion in spending, focused on things like the border and defense, energy as well, punting tax policy discussions until later. But we had the chair of the House Ways and Means Committee, Jason Smith, on Bloomberg Surveillance yesterday, and he maintains that if Republicans want to get all of their objectives on tax policy done, they need to do it in one big bill where there's incentives for lawmakers to agree to other things because of things they may like on the border and that kind of thing, that it's just really difficult to get multiple budget reconciliations through the House in just 1 year period. So we'll see if they come out of the White House with more clarity here. It is going to be Republican leadership in the House as well as others, and we may very well see them as they emerge from the cabinet room in the West Wing, going to the sticks, as you will, to answer questions for reporters and get some clarity on the path forward.
Well, Callie, how much, leverage and time does the president have to give to this?
Well, timing is the interesting part of this, Bonnie, because he obviously has come out of the gate trying to use all of his executive power to achieve as much as possible through things like executive orders. The legislative part of this, with tax policy, getting more money for his border objectives, is really what he needs Congress for. And if he wants to be able to achieve this all within the first 100 days, that is where the clock really is ticking. The timeline that was outlined by Speaker Mike Johnson was that the budget resolution markup in the House would happen this week. It does not look like that is going to be the case because he wanted to be able to get things passed by the end of February with the ultimate objective of having reconciliation through the House before the Easter holiday in April. That timeline looks like it is being slowed down materially, though. It's unclear whether President Trump will be satisfied with that, as he really wants to have early wins here. And that is where he may find himself, or Senate Republicans may find themselves trying to convince him that he could get early wins on things like the border by separating these things out and doing one reconciliation package before the other.
So we'll see how that shakes out. But, Callie, I want to switch gears and talk a little bit about Treasury and Doge and what that political football looks like. The latest reporting we have is that Treasury access by Doge was partially limited by a judge for now. What do we know?
Yeah, this is a district judge here in Washington, Katie, essentially has pulled back on the ability for those close to Elon Musk, two individuals, to share information about the Treasury payment system or gleaned from it with others. Two others close to Elon Musk will still have access. But this is essentially not a resolution to the lawsuit that was brought on behalf of unions like the AFL-CIO, who suggest that Elon Musk having access is illegal because he can see things like government employees' Social Security numbers. The judge is still going to be hearing arguments about this later, which will get us to a firmer resolution. But this is essentially as a bridge, as we have seen a lot of uproar over this access. And of course, the Treasury Secretary, Scott Bessent, has said that this is read-only access, that they aren't actually able to disrupt the payments that Treasury is making or have control of that in any way. But that hasn't been enough to assuage a lot of concern on the part of federal employees or the unions representing them. And of course, Democrats, who have had strong words for Elon Musk and everything he's trying to do with the Department of Government Efficiency, including, of course, efforts to slim down the federal government. And there is a deadline of midnight tonight for federal workforce employees to take a buyout offer that would see them paid, in theory, through the end of September if they voluntarily leave by the end of this month.
Right. I think we've seen 40,000 so far. It'll be fascinating to see what the final number is. Balance of Power co-host Callie Lines joining us from Washington. Really appreciate the time. Meanwhile, a quick check on these markets. A slight rally underway, slight gains on the S&P 500, on the NASDAQ 100. Your 10-year Treasury yield currently about 1 basis point higher. Not too much going on there. Really looking forward to that interview with Scott Bessent coming up, because we know he's watching it.
That's going to be a market-moving interview for sure. Also, of course, Amazon earnings out after the close. They absolutely will be market-moving as well.
Absolutely. Sentiment in the stock market at a really interesting place, so we'll see.
Eco data tomorrow.
That's true. Big jobs day coming up. And to that point, we have a great lineup for jobs day. Coming up tomorrow, we'll be joined by Rick Reeder of BlackRock, Julia Coronado of Macro Policy Perspectives, plus from the C-suite, Elf Beauty CFO Mandy Fields, as well as FICO CEO Will Lansing. We'll see you tomorrow. This is Bloomberg.